there are 15 possible paths because the future is very, very hard to predict. And then again, back to what we mostly come down to is how smart is the team? Like how smart, how resilient, how experienced, have they had demonstrated success together, have they worked together? And then, because that means that they'll be able to pivot and find that appropriate path as they go. So typically we're just looking in that $6 to $25 million range, and then we're sort of scaling it up based on their relative excellence compared to the other deals in the pipeline, and then how much traction they have so far and how large that potential opportunity is. It's difficult. I think a lot of the later stage has been really perverted. Since 2021, there was this period of massive exuberance, and it was these non-traditional investors, hedge funds, and holding companies, Tiger, Global, SoftBank, these guys come in. The entire venture market is typically like $120, $150 billion. They have funds that are $120, $150 billion, like individual funds. So they just ruined the industry, literally doubled the size of the venture market within a 12-month period. That just messes up all the prices. And so especially, they started at the way later stages, just pre-IPO, and then they were like, oh, let's go earlier, we'll go to Series D, we'll go to Series C, we'll go to Series, and at each step, they pushed all the VCs in those stages one step earlier, and it came all the way down to seed, but at seed, we only went up like 25, 30% valuations. They didn't go crazy. But at like the later stages, they were literally double what they should be, almost overnight, like within a period of a month, valuations just doubled. And this is the problem for the exits is, it takes a while to grow into that valuation. Like they were unreasonable valuations then, they're still unreasonable today. They haven't caught up, and this is where the exits can't happen because nobody wants to take a markdown, nobody wants to permanently lock in that loss. They invested at stupid valuations. So, but the seed stage is actually better. I think we didn't get that exuberant. We were impacted, but not as bad. And I would say today the valuations I find are relatively normal. Like we do see, for super hot areas, you do get arrogant founders that come in and are like, oh, we want, it's two of us with an idea, we have zero traction, it's a $50 million valuation, and it's gonna be closed by tomorrow at noon, let me know if you want in, and mostly we're like, all right, good luck with that, we'll see you later, we're not interested. But they will often close it. Like if it's in a super hot area, the money is there for those, and you do see stupid valuations even at the early stages. But we are mostly focused on those founders that have a reasonable expectation and recognize you wanna work with great people, and you want to take a really thoughtful approach to building a genuine, sustainable, defensible company. And that typically means that they're taking reasonable valuations. Maybe slightly on the high side if they really are optimistic, but not crazy because you got to work together for a long time. So, yeah. I don't know if I answered the question exactly.
We're very much aligned. We see the world the same way. For us, the one thing I'd add is we're ownership driven as well. So for example, for us, we write checks 2 to 5, and I think you do too.
Yeah.
$2 to $2.5 million checks for like $5 million rounds, where we aim for double-digit ownership. So that definitely puts a cap to how high we can invest in a post-funding basis. But very much agree on what we're seeing. I mean, we would see the same things in terms of valuation. How is, or when we value companies, where is the AI, where's the tech, where's the founder, where's the market, how big it need to get? Like all of those are arts more than science, frankly. And then even today with AI, I've seen a lot of early stage companies get a little more revenue than before because it's easy to get revenue, but that sometimes can be false signaling because it raises the question of how durable is this revenue. You have all of these enterprises who are trying to adopt AI within their organization, and they go and look at the startups, say, oh, let me buy 5 of the same at very cheap prices, and the next year they can churn. So in a way, the sustainability and durability of revenue is a question mark, and it's something we're paying attention to more now.
So you're saying that there's no spreadsheet, you just plug in numbers and get the valuation of that?
There is a spreadsheet, how accurate that is.
So Dee, are you having a ChatGPT model agent which runs your valuations for later stages, or how do you go about doing your evaluations?
Then what am I going to do?
Yeah, exactly.
I mean, this could, literally, I mean, when you think about our business, I mean, all sectors, right? I mean, one of our MDs, about 3-4 months ago, we were on a call, and he's a couple of years older than me, and he's like, Dee, how often do you use ChatGPT? And this is like about 4 or 5 months ago, like once a week. And he's like, well, you're gonna be out of a job soon if you use it once a week. I'm like, well, relax, right, what's going on? And then he's like, goes on a rant that, we've got to just use it more actively to source deals, interact with the customers across the board. And I'm like, wait, this is not very good for our job security. He's like, dude, we're all going to be done in 5 years' time anyway. So, all sectors are being impacted, but not being more serious. Look, I don't have any, my top level observation is that in a lot of these disruptive areas, with AI, I can talk about the blockchain crypto space when it comes to valuation. The traditional methods that we have grown up on are, I wouldn't say irrelevant, but much less relevant. Because the business models that are emerging across AI and crypto, and particularly those areas, are not the way we used to run SaaS models and value companies in the past based on SaaS, which was, how much have you put in, generate revenue, demonstrate, hopefully drive towards profitability, what's your EBITDA, what's your growth rate on that, here is a DCF analysis, put a nice hurdle rate on it, and come up with what fair valuation would be. It's even more accentuated in the crypto and blockchain space on two levels. One used to be that there was some kind of correlation between size scale in terms of headcount and scale and size. Now you've got literally $500 million enterprise value companies, and they've got 3 employees. Right? I'll, again, in the crypto space, you look at the largest stablecoin issuer, Tether. Right? Tether made about $5 billion in profit last year. They got 140 people. Okay? And that's still, and they think they can do that with 100 people. Right? So you're seeing massive size and scale, both in terms of revenue, with first and foremost, very few people. Secondly, the direct correlation between the revenue generating and EBITDA and the straight relation between that and valuation is much murkier in these sectors. And again, I'm sorry to take an example in the crypto space. There are a lot of companies in the crypto and blockchain space whose enterprise value is not driven by the revenue they generate, but the price of the token that they issue. So they're giving up their you can go and use the services for free as long as you're using the token, and because you're running on utilizing the token, the price of the token goes up, and therefore the enterprise value goes up. So when you look at the P&L, the profit and loss statement, it's shocking because you look at the number of the companies valued at $1 billion, and revenue-wise, they're making 30, 50 million. So it doesn't justify the multiple. But the entire value, enterprise value, is driven by the price of the token. So it's all about a network effect driving activity using the token. So long story short, coming back to AI, I don't have a simple answer. We're grappling with it every day because we've got to defend the valuations that people have in the early stage.